All right, we're going to get started here this evening. Welcome. I'm so glad to see you all tonight. My name is Megan Dixon, and I am the Director of Community Investments and Relationships with both Integrated Tax Services and Johnson Bixby. And we're just delighted to see this room full this evening, aren't we? Thank you so much for being here tonight. This is one of our Ripple events. Ripple events is a series of educational opportunities that we present every year, and this happens to be our last one of the year. So this is a good one to be at. And as packed as this room is, we actually have more individuals online. So tonight, this is a hybrid version. We have close to 50 people zooming in as well. Because this is a different version than maybe what you're used to, we've asked that tonight, when we're going through the presentation, that all questions wait until the very end. That helps us provide a better experience for all of our friends who are zooming in this evening. Our hope tonight is that you walk away with the tools and the resources that you need to make a more informed financial decision for your life. That's really what our Ripple events are all about. And what a way to end the year than with tax updates. So I'm so pleased to introduce our speakers tonight. First, we have Heidi Johnson Bixby, the CEO of Integrated Tax and Johnson Bixby, as well as Ralph Doggett. He's the Senior Managing Director at Integrated Tax. And Ralph just joined our team not too long ago, and we're thrilled to have him with us. Both he and Heidi have a deep passion for providing this type of information to our community. So let's give them a big round of applause.
So Ralph's going to start with the tax update side, and then I'm going to come and talk about the fund planning side, where all you put the pieces together. So Ralph, I'm going to let you take it away.
Okay.
He doesn't like the senior title, and it really is experience, not age. Clarification.
Thank you. Great introduction. I appreciate that. Let's start with a story, if we could. Back in the late 80s and early 90s, Money Magazine used to send out a sample tax data to 50 different preparers across the country. Does anybody remember those articles back in Money Magazine? They would send out the same data, 50 different preparers, and many of those years they got back 50 different answers. And it was common. Actually, that was why they stopped doing it, is because it highlighted really three different things. The first thing was there were a lot of preparers that didn't keep up. They didn't do continuing education. They didn't study. They would just put it down, or they didn't have somebody checking their returns. They didn't have somebody looking at the data after they had input it, okay? The second thing it highlighted is the complexity of the tax code. I mean, it's what, over 70,000 pages long. It's absolute insanity, and that's just code and regs. That's before you get to the private letter rulings. It's before you get to the court cases and all of the other pieces that go with it. I mean, it's over 1 million words in just code and regs. I mean, it's just absolutely enormous. The third thing that it highlighted, and this is to Heidi's point, is the planning. There are legitimate different answers that you can get with the same tax data depending on how you approach it. Back in the Money Magazine days, I believe the guy's name was Fitzpatrick, and he was over at Grant Thornton in Portland. They're the ones that put those data sets together, and he would come up with an answer as well. And that answer, in his footnotes, he would say, this is only one of the legitimate possible answers. And it depends on how you do the planning. You can have more tax now, less tax later. I mean, you can have all sorts of different scenarios depending on how you do the planning. Did I mention planning? Yeah. So tonight we're going to start with the disclosure page. This is an important piece because, as I just mentioned, all of these things are so complex. You have got a layer of complexity every time they do something like this. And we're going to show you some of those tonight. The agenda, we're going to go through why professional guidance matters. We're going to talk about 25, 26. We're going to talk about some of the planning opportunities. That's where Heidi comes in. Let's just do this one. This tax law is over 800 pages long. The paperwork that we received as the summary is over 200 pages long. the slide deck that they use to teach our class, the practitioner class, is over 100 slides long. So I figure we're going to go through all of these tonight. We'll get you out of here by midnight, but we'll know lots about this tax code, right? I'm just kidding. We're only going to do the highlights and just hit a few of them at this point, okay? I don't think we have quite enough wine to keep everybody here until midnight. So Heidi is fond of saying that we are your number translators, and that's really what our job amounts to. We take all of the input, we figure out where it's supposed to go, and then we do planning with it if you want us to do that, and then out comes a tax return. It's an amazing process, and it'll benefit you guys a lot if you do the planning. The definitions that we're going to talk about, and I think there was a handout with this in it, right? You're going to see these words come up time and time again. Some of them are familiar: MFJ, married filing joint; S for single. I like to think of Irma and Maggie as names. That's how I remember them. But you'll see these come up, and there's probably some in here that that we don't even cover. All right, let's hit the 2025 tax brackets. And these are adjusted, these are changed a little bit. What I want you to notice is that, number one, these are taxable income items. This is after your standard deduction or after your itemized deductions and things like that. And so I want you to notice the 10% marginal rate and the 12% rate. Those are a pretty big leap to 22. That's a big difference. The other thing that happens at 12% is if you're in that 12% bracket or lower, your capital gains are tax-free. It's phenomenal planning opportunity, right? And the other thing that you notice here, so this is a single filer. A married filer, same idea, basically double, until you get to that 35% bracket. And here's another thing that we have a lot of higher income people. If you've got two higher earning as a couple, oftentimes it's better to have them single than it is married at the very highest bracket. It's just an option, not for everybody. Does that make sense? Okay, so let's look at the standard deduction. Everybody knows what the standard deduction is, right? It's what you get if you don't itemize. And the standard deduction has been around for a long time. I mean, 1944 is when it started. 1964, it was just 1,000. TCJA, what does that stand for on your charts?
Tax Cuts and Jobs Act.
Tax Cuts and Jobs Act. Thank you. That was where all of this new large standard deduction started. And it's a lot of people didn't have to itemize or didn't get to itemize after that tax bill in 2017. And so now in 2025, here are some of the changes to that. The standard deduction is much higher than it was before. You've got senior addition, that's that $6,000. Now that $6,000 was actually billed as you won't pay tax on your Social Security. That's the way the press projected it, right? It has nothing to do with your Social Security. It has to do with your age, and that's it. It does offset the tax. It is an above the line deduction. And then if you're over 65, you get another standard deduction. And if you're disabled, you can get even more. I mean, the maximum standard deduction is $46,700 for a married filing joint, $23,750 as a single. I mean, it's an amazing amount of money. And a lot of people are not going to itemize based on this new standard deduction. We are going to change that for some people, however. So we'll get to that one here in a second. This new standard deduction, though, isn't just for everybody. I mean, they phased out a lot of this stuff. So if you're over 65, you get the $6,000. But it starts phasing out when you're 75,000 of income, if you're single. And it goes away at 175,000 of income if you're single. Married filing joint goes away at 250,000, starts at 150. You get the idea, right? So they're going to give you a benefit, but it's really only for the middle-ish class. If you're very wealthy, you're probably not going to get this, or have a lot of income. You're probably not going to get this. You get it whether you're itemizing or claiming the standard deduction, either one. If you turn 65 January 1st of 26, it's deemed 2025. So anybody here has that issue, but that's a pretty good deal. The next piece, and this is going to be common for a lot of the tax stuff we're going to look at. There are a lot of states that are not going to go along with these federal changes. And so right now, check my list, Iowa, Montana, North Dakota, and Oregon have basically said they're going along with the federal changes. States, California, Connecticut, Hawaii, Massachusetts have said they are not going along with these. And so you really have a two-tiered tax structure. You've got whatever the federal government is, and then you have to make adjustments on the state return. So it's going to be interesting doing the tax returns this year. The other states that have an income tax, we don't know yet. Maybe their legislature hasn't met, or whatever's happening there, we don't know. So we'll see where that all goes. But state issues are going to come up in every single one of these new tax laws to see if they go along. So how many of you remember back in the 80s when you could deduct interest on everything? Mortgage interest, credit cards, car loans, boat loans, everything, right? All deductible. I mean, that went away in favor of, okay, you get mortgage interest in $100,000 HELOC, right? And someplace back in the 80s. Now this new tax law says you can buy a new car if it meets the criteria. You get up to $10,000 of interest to deduct for the next 4 years. It's a pretty good deal. The criteria is it has to be a U.S. Say this right, an assembled in the U.S. vehicle. And you can tell which ones are assembled in the U.S. by the VIN number. If the first numbers on that VIN are 1, 4, and 5, that was assembled in the U.S. And if you're buying a new car, your dealer's going to point this out, I'm sure, because they want you to buy the car, and this is a great selling point. It can be cars, SUVs, trucks, motorcycles. Everything has to be under 14,000 pounds. So it can't be a big box truck or something. No leases, no campers, and no RVs. But if this works, and it also phases out, it starts at 100,000 of a phase out on single, 200,000 for married filing joint. So does this make you want to go buy the Ferrari or not? Thinking if you have to finance the Ferrari, that's maybe not a good idea. All right, here's the next one. Again, we're just running through these really quick because there's so much to this. This is a great one. And I am so fortunate, so blessed, so thankful that I do not do payroll, because it's the payroll people that have to calculate this tip stuff for the most part. So it's only 4 years, but it's up to $25,000 per return. So if you've got two partners and they're both tipped individuals and they both have lots of tip income, you're limited to $25,000 per return. So keep that in mind when you do your planning. It's only what we understand. A lot of this hasn't been written yet, but we understand the extra add-on that they do on those on the receipts, where they say here's an extra 20% or 8% or 10%. That does not count as tips generally. It might be a cost, but it's not a tip. It's only ordinarily tipped to jobs as well. So I mean things like wait staff, right? Hairstylists, valets, people like that, chefs, things that might normally get a tip. And it does not reduce Social Security and Medicare tax, the FICA stuff. It's a calculation. In theory, if you are tipped, it should show up on your W-2. Here. It's all new this year, right? In addition to raising your tax prep fees this year, we've decided to put this on the checkout every time you come in. I mean, I tried to get him to raise it from 18 to like 20% minimum. I mean, that's what Burgerville. I mean, so the 18, 25, 30 custom. So we're not doing that. But what if we did? would that work? Would we get $25,000 of tip income tax-free? The answer is no, because we're not ordinarily tipped category, right? So it's going to be an interesting time. Here's another one. And this doesn't apply to tax people because none of us ever work overtime. So we're good. But overtime is another piece where you get to deduct up to the 25,000 if you're married filing joint, 12,500 if you're single. And the idea here is it's going to show up on the W-2 as well. Box 12, box 14, we're not exactly sure which one, but in theory, the payroll people have to calculate this one as well. And some of the changes here, it has to have a valid social security number. You can kind of see where that's going, right? Valid social, it won't reduce your social security and Medicare. We're back to kind of Heidi's planning ideas where if you look like you're not going to make it or you're going to be phased out because of the exemptions over there, you might do planning and put more in a 401k or do something along those lines to get your income down so you can take advantage of this. It is only a 4-year deal, but it's a pretty good deal for those working overtime, right? Are we having fun yet? It's exciting. All right, so let's talk about SALT. And that's a definition on your thing. It's a state and local tax. This has been around for a long time. Again, 1944, they started restricting to income tax, property tax, and sales tax. By the time you get to 2004, they brought back the sales tax because people in states like Washington that don't have an income tax and have withholding said, well, hey, wait a minute, we pay sales tax. Let's add that in. And you can do that if it's greater than your withholding or the amount they give you on the chart, right? So we do. I mean, we have some people that track every penny of sales tax, or they're building a house and they paid a bunch of sales tax. Sometimes that works. But the old limit to this category was only 10,000. And you guys know how itemized deductions work. It's mortgage interest, property taxes, charity, and maybe medical if you're really in bad shape and you have a lot of medical expense. That has to get higher than your standard deduction, right? So when they limited the state and local tax to 10,000, a lot of people got topped out. They never did it. But you've got people in Oregon, California, all these other states paying, 10, 20, 30, 40 grand in withholding, and they don't get to deduct them. So now with this new bill, the increase is up to 40,000. At least for the next few years, it's state, local taxes, property taxes. I mean, it's all of these different pieces that now, if you didn't keep track of all of these things because you thought you weren't going to itemize, you might have to go back and recalculate those this year because you might itemize, especially if you're in another state that has an income tax. Make sense? We also don't know what the single filer phase out is yet. It hasn't been written. And you know what Congress does with this stuff, right? Congress passes laws based on what they're trying to accomplish. You want to sell more houses? Make mortgage interest tax deductible, right? I mean, that's just an example. And you see where all of these different pieces get taken into account when they're doing tax law. But Congress doesn't write all of the nitty-gritty little rules that go along with it. They kind of shove it off to the IRS for that. And that's where some of this hasn't been actually all put together yet. Kind of flying blind a little bit on some of these. PTE payments, does anybody have partnerships? If you have partnerships, that was a workaround to the SALT limitations. Doesn't apply to everybody, but that has not changed. So if you're in that, you know it. All right, here's another one. Child tax credit. It's been all over the board. It's basically permanently increased to 2,200 now. The refundable portion is 1,700, and it's for the children that qualify. And here again, you notice that you have to have a child with the Social Security number and at least one parent with a Social Security number before you can get the child tax credit. Okay? So part of Heidi's planning opportunity would be to reduce your taxes, have more children. It's an option. It's worth that, but so here's another one. This is one that doesn't come up very often, but it is an enhanced deal. And it is a credit. Remember, the credit is better than a deduction, right? Credit is a dollar for dollar offset in your tax. The adoption credit changed a little bit. The amounts changed. The phase outs changed. Now Indian tribes can decide what's a special needs child. And I don't know if it offsets the cost of a whole adoption because those can be expensive, but it's a decent credit if you do. And yes, this is for humans only. You cannot go to the pound. You can't get your dog or cat and claim an adoption credit. Sorry. Let's look at a couple of the business pieces to this. Again, Congress writes these things to stimulate parts of the economy and use the tax laws to do it. So you've got businesses that can now write off $2.5 million of improvement or new equipment of whatever they've purchased for the business with a limit of 4 million. You can see over the years how that's increased dramatically. So they're trying to bring back, using the tax code, they're trying to bring back manufacturing, doing things like that. And that can be a great deduction. Another one, research and development. Another piece where small businesses, if you're worth, under 31 million in gross revenues, you get to write off all your research and development costs. Okay. Third-party settlements, and the name on this one is not easy because third-party settlements really think of your hobbies. That you sell your stuff on Etsy, Facebook Marketplace. What if you sold your old lawnmower on Facebook Marketplace, right? Well, the proposal for the last few years has been every single one of those things should be reported if it's over $600. And Venmo and Face and all these eBay and everybody said, wait a minute, number one, that's a huge burden. But the IRS is trying to say, hey, you sold a whole bunch of stuff, you owe tax money, and this is how we're going to catch you. The IRS finally pushed back and said, we can't handle that much paperwork either. We don't want these 1099s for a lawnmower because in theory, if you sold your lawnmower, you paid $1,000 for it, it's only worth $600, you lost money, it's not deductible. And it's not a gain, so it's not taxable, right? So they basically came up with this, that it says you have to have 20,000 in income and over 200 transactions. Now, I want to make it clear that when you get your sales, those are income. It doesn't matter how much it is, right? Even if it's 600 or 500 or 400, if you've sold something, you're selling stuff for a hobby, doing whatever, it is a taxable event. The reporting is now the 20,200 transactions. Does that make sense? So if on the tax paperwork we ask about a hobby, I don't want you to think, oh, I didn't make more than 20 grand, I don't have to put it down. You still need to tell us about your hobby and other income items or businesses and things like that. Okay?
Does it have to be a legal hobby?
That's a great. I'm going to violate the rule of holding the questions because that's a great question. And the answer, does it have to be a legal hobby? The answer is no. They catch a lot of criminals through the tax court cases that they can't prosecute otherwise. It is fascinating because when you sell drugs, when you do all these things, that's a taxable event, right? And generally they're not filing a tax return to report that income. And so great question because it doesn't have to be legal. It's technically taxable. So next one, this is going to be a big one. For some people, it's going to make a difference. The energy credits are going away or they're phasing out or they're done already, all right? Your new and used energy credits, the cars and things like that is gone. You've got another month and a half or so to do your solar and wind and and heat pumps and all of those things before that's gone. And I got a call today about, hey, I'm trying to get this done before the end of the year. What should I know? And you got to go with the installers, because they should know which ones of their systems are going to work. And if you can get it done before the end of the year, it's a pretty decent credit. Again, these are credits, which is better than a deduction, right?
It has to actually be installed.
Yes, thank
correctly?
you. Has to be installed by the end of the year. You can't just pay for it December 28th and make this happen. So installed, in place. The last one on the end, this is another one where the IRS pushed back. It's the same kind of an idea. 1099 NEC is non-employee compensation. It is when you hire somebody to work at your rental, for example, if they're not incorporated and you pay the plumber more than $600, you're supposed to send them a 1099 that says, look, I paid you money. And that goes to the IRS, and the IRS knows about this person's income, right? So the IRS didn't want that much paperwork either. The new limit is $2,000. If you pay a contractor or somebody like that to work on a business property, you've got $2,000 is the limit now. Okay. All right, let's go on to 2026, since we're having so much fun. All right, anybody under 30 in this room? We probably have some online that are under 30. Okay, so this next one might not make much sense to you. Just go with it. Most people under 30 have never seen one of these. Just kidding, it's fine. The IRS is trying to get rid of checks. They don't want your checks, and they don't want to send you a check. There are exceptions. You can have estates, you can have trust, you can have unbanked people. I don't know how you prove that, but they are not going to send out checks. You have to give them your bank account information if you want your refund. And that is going to be an issue for some people because they hate the idea of the IRS having their data. I get it. And if you want to make a payment, let's say you make quarterly estimate payments or balance due payments at the end of the year, you're going to have to pay that electronically. You go to irs.gov, make a payment. Can I suggest you make sure you're on the right site before you do that? Right. But they're going to want that taken directly out of your checking account instead of doing paper checks. So if you send them a check in January to pay your quarterly estimate payment, chances are you're going to get that back in the mail. You're going to be late with your quarterly, and they're going to charge you interest and penalties. So electronic is the way to go with this stuff. You've got to get this stuff in, get used to it. It's going to be an issue. All right. New, again, this is 2026 now. They've come up with all sorts of new stuff. Charity now has $1,000 or $2,000 amount you can give to charity. It has to be a 501c3 organization. You have to have receipts. You have to have the same rules, but you can now just deduct this whether you itemize or not. If you do itemize, you don't get this one because you're going to put that on the itemized section. It does not include goods and services. It doesn't include any of those things. It is an above the line deduction. You don't have to itemize to do it. And the contributions to a DAF, a donor advised fund, are not eligible for this. You can't put the 1,000 or 2,000 into a donor advised fund and make it work for this deduction. This is where planning comes in because you can do that for other things.
How about in kind?
And this does not include goodwill or any of the stuff you might give away. All right. We have a new charity floor as well. So you know how medical deductions work? If you get more than 7.5% of your income as a medical expense, you get to deduct what goes over the 7.5%, right? They are now starting that with the charity. It's only 0.5%, but you basically, if your adjusted gross income is 200,000, the first 1,000 of giving isn't deductible in that little scenario. Okay, it's that 0.5%. You have to get over that hurdle before you get to deduct your charity. So donating things this year, maybe doing donor advised funds. Heidi's going to talk about all of those pieces, but we're back to the planning piece to make this work. It's only cash contributions, not goods and services again on this one. And that has no phase out. It's just for everybody. All right. So this next one. Oh boy. Is everybody familiar with the health care coverage that you get if you go to the exchange, right? Right. You say, hey, I can't get it through my employer, or I want it through the exchange, and you go on the exchange and you say, I need this health insurance. And if you tell them you make no money, they'll give you a really nice premium subsidy. It'll be great. And it might even take all of your payments away. You might not have any cost. But the new tax law is they have brought back the 400% of poverty rule. When you get out to the end of the year, if you have made more than 400% of the federal poverty rate, which I think for a family of four is like 120 grand or something.
Single's 58.
The single's 58, there we go. So if you make more than that and you're getting this premium subsidy, it's a cliff. You fall off that cliff, you pay all of that money back that you got as a subsidy. So when we did the analysis here in the office, I think we had 40 something people that had the premium subsidy, and it would have applied to 2 or 3 of them, I believe. And that's what you're going to find out there. People are going to be surprised because they have not counted their income correctly. They haven't told the exchange what their income really is, or they had a windfall. Something changed. I mean, if you're on Medicare and all that stuff, it doesn't matter. But if you're on that premium subsidy, it's going to be an issue this year. And you're going to get a huge tax bill because you got to pay it all back if you got it during the year. The HSAs are expanded, health savings accounts, high deductible health plan qualifications are changed a bit. And the high deductible health plan piece and the HSAs are an amazing planning opportunity as well. Doesn't say you have to use them right now to do all of your stuff. You can calculate and carry those receipts forward, reimburse yourself out of earnings. Again, we're back to another planning opportunity with HSAs if you've got. All right, next one. High income. So is everybody familiar with the alternative minimum tax? AMT, back in the 60s when tax rates, the highest rate was like 90%, but everything was deductible, including your interest on everything. Wealthy people didn't pay much tax because they could deduct everything. So alternative minimum tax came in and said, you figure your taxes with all of your deductions, and then you figure them with none of your deductions, and you pay the higher of the two. Well, it's going to be higher with no deductions, right? So over the years, they have reduced that alternative minimum tax issue, changed the brackets, done all sorts of things. A lot of the high tech industry workers got hit with AMT because of their stock options. Their stock options were an AMT adjustment, right? The AMT really isn't as effective or as applicable anymore. Although with the SALT limitation, SALT, and that state and local tax is an AMT adjustment. So you might see more and more people hitting that this year than you did last year. Again, you're back to the planning because all of this matters. The Mr. Pease, I think Don Pease, congressman, legislature, whatever, introduced a bill that said, hey, AMT is not tax and rich enough. We got to come up with a new formula. And so this is, the calculation is nuts. I'm just grateful that computers do this stuff, right? 2/37 of the lesser of the total itemized deductions. Basically, if you're making $650,000 in income and you gave away $200,000 because you were funding a donor advised fund or you were, doing something big to charity, you'd pay an extra $2,000 in tax because of this extra AMT type adjustment. Do we need more wine? Okay. Next one, 529 plan. Everybody familiar with 529s? You put the money in, you use it for education. It comes out tax free. It's a pretty good deal. The tax law in 2017 increased what you could do with that, some of that money. You know, 10,000 you could use for private school, kindergarten through 12th grade. You could do 10,000 for student loans. You could do roll over to a Roth. That was a new one. So if your kids and grandkids didn't need the money, and you didn't want to go back to school, you could literally roll some of that over into your Roth account if you follow the rules
Only the kids.
and get that all done. Yeah, for the kids, right?
The kids.
Yeah. But if they didn't need it, if they didn't use it for school. And the new rules, expanded qualified education for this tax law, you can do 20,000 for K through 12 online. You can hire tutors. You can do continuing ed and pay for them that way. And the 529 rules have been expanded that way. So it's a pretty good deal.
I mean, a quick note just for the 529s, if you do take it out for education, K-12, and you are in a state like California, California will tax you. Federally, you're not taxed. So some states will tax the distribution.
Yes, good point. Thank you. We're back to that. Hey, the states might not go along with all of this stuff. So the states will tax, some states will tax those distributions coming out of a 529 plan for some of these extra pieces that the new tax law gives us. Okay. Mortgage interest. This is a fun one. Didn't change much. You can deduct mortgage interest on up to 750,000 of debt. It is now per person that owns the place, not per house. This was in the Ninth Circuit that they just came up with a court case that said there were two people that owned a house together. They were not married, and it was a per person limit, not a per house limit. And now mortgage insurance premiums are considered interest. So a little bit easier to afford a house there, maybe. Let's see, estate tax limits. This is a big one. Federal government estate tax limit, 15 million, effective January 1st. 30 million combined if you're married. You might consider doing the portability, which is filing the 706 tax return to claim that person's amount, even if you're under the 15 million. So if you're married, let's say you have 2 million, you might do that portability election because you want to capture that 15 million and carry it forward. Because the thing that is not constant here is that 15 million. I mean, we've seen it at what, $1 million? We've seen it at 600,000. We've seen it at 0. I mean, there's all sorts of changes that could happen to that 15 million going forward. And the tax rate, if you go over the limit, whatever that number is 40% at this point. And it is a big tax, which is why you have planning opportunities for the very, very wealthy that include all the trusts and all sorts of different pieces that way. Lifetime gifting, all of those different categories. So just be aware of that one. The estate tax limit in the state of Oregon and the state of Washington are going up. I don't have those handy.
3 million for Washington.
3 million Washington.
Oregon is staying at $1 million.
Okay, so Oregon is $1 million. And if you have Oregon property and you live in Washington and you're over the $1 million, you still have to file in Oregon, even though that property isn't over $1 million. It's really detailed and a lot of work to put those together. Okay. How much time do we have here? Okay, a few more points. Tracing rules for interest. You can borrow money on your house. You can borrow money on a rental, and it depends on what you use that money for. If you're starting a business, if you're buying another rental, it might be deductible, but you trace the use of that money to where you spent it. If it's buying a car, doing something like that, and it's not business, it's not deductible. Gambling, how many professional gamblers? We don't want to know. If you're a professional gambler, you can now have phantom income because you only get to deduct 90% of your losses. So if you make 100 grand gambling, and there's a lot of people that do. I mean, they're playing poker, they're doing whatever, some of them do pretty well. If you have 100,000 in expenses, losses, things like that, you only get to take 90% of those. You have 10,000 of income in that example. That's phantom. You didn't get it, and you still have to pay tax on it. So this doesn't apply to the slot machines and things like that. But scams, These are huge these days. I saw one last year. It was written up in the Columbian. They lost $500,000. It came out of their IRA. What do you suppose we had to tell them when it came out of the IRA and they lost it in a scam? It's taxable income to them, right? So they're going to have another 200 grand of tax on this money that they already lost. And the IRS says if it's non-Ponzi scheme, it's not deductible. If it's an investment loss, if you thought you were investing in something, you can take it as a loss, but you got to be really careful with this. It's out there.
Well, I'm gonna go back to two things on it's really important if you do have rental income or if you are the tracing of interest. So you have to really pay attention. If you use the equity in your primary residence to use it to buy a rental, the interest is not deductible because you didn't use it for your primary residence improvements and it got used to buy something else. So the tracing of interest is an important one to understand how you finance something or come up with the money for it as to whether that interest is taxable. And the other thing I'm going to say on gambling, because it's not uncommon that people have gambling winnings on their tax return. If you're going to the casinos just like to have fun, get a card, register your transactions with the casino so at the end of the year you can get how much did I actually spend. Because if you are happy and lucky to win $3,000 or $5,000, or you see, sometimes we see $20,000, $25,000, you need to show how much you spent to offset that income that you got to help reduce the taxable event. So if you're going to the casino, get the card so they can track how much you're spending to offset that income you're going to win.
Okay, so did we get that for the online people, or do I need to repeat? Are we good? Okay. Non-deductible, all those fun things. There is a deal, and this is really a small number of people, but it's a qualified elementary and secondary education scholarship. If you're given scholarships or an organization that gives scholarships, there might be a small credit. Just know that it's out there, and you can research that a little bit further. But it's $3,400 of a credit. That's pretty good. Here's capital gains brackets. These are quite large. I mean, the 0% rate is up to 96.7 for a married, 48,350 for a single. It's a pretty decent rate. 15% goes up to $500,000 or 600,000. I mean, it's a lot of planning opportunities that go along with these capital gains rates. Heidi's going to talk a little bit more about those. Here's the 2026 tax brackets. It's just a little bit an increase from 2025. And you'll notice again down at the bottom, the rate between 35 for single versus married filing joint isn't the double. So if you're a high income couple, that might be something different to look at. And then we'll turn it over to Heidi, and we'll do the planning piece, and then we'll do questions and things like that later, right?
Yeah.
There we go.
Yeah.
Okay.
Okay. So you've heard all the numbers, right? You've heard all the new rules, the tax brackets. You got your handouts. Like, how do you use some of that information? Like, it's a lot of information to play with, but I'm going to just highlight a few things. I do want to answer a question that was online, though, on whether a lot of what Ralph went over is indexed for inflation. And almost all of it is either a set amount, like 99% of it, or the new tax brackets come out every year. Those aren't indexed by a certain percentage. Those are reissued every year. And the other one we didn't mention that I thought of is the $19,000 per person gifting limit. So any one person can give to another person $19,000 a year, and there's no reporting, doesn't show up anywhere. So each one of you can give me $19,000 and it wouldn't show up anywhere. I can receive it tax-free. You come up with the money So I'm just saying that 19,000 is the same in 25. It's the same in 26. It's not going up. It had been increasing a little bit, but it's also 19,000 in 2026. And then the one thing that is indexed for inflation, and this is new and exciting. I mean, we get all geeky when we get the new tax book. We're excited because the Washington State estate exemption has been 2.2 million for decades. I think my entire career, almost like decades. And it just changed in July to 3 million, but also being indexed for inflation going forward. So that 3 million will index. The 15 million federal will also index. So those are the only two things of all the information that we went through that have an index automatically built into them. Okay. So Ralph talked about the capital gain tax, and if you're in a 10 or 12% tax bracket, the capital gain tax is 0. I mean, 0 is a pretty cool number. In the Subaru ads, 0%, you can finance a Subaru. All right, let's pretend you're single, you're under 65, and you have gross income of $60,000. And you either contribute to a 401k or you make an IRA contribution, but you make a retirement contribution and you have no capital gain, no, you didn't sell anything, you didn't create any gain. So your adjusted gross income before taking the standard deduction or the itemized deduction that Ralph talked about, just quite high as you can see. You have adjusted gross income of 57,000. And if you take a standard deduction, that's $750 for someone who's under 65 and single. And so you end up with taxable income of $41,000. The first 11, look at your charts, the first 11,925 is at 10%, and then up to 48,000, you're at 12%. So you're still in a 12% marginal tax bracket, and your total tax is $4,700. Where the planning can come in is if you end up having the same income, the same retirement contribution, and you end up generating $6,000 in capital gain because you sold that stock that went through the roof and you have some gain in it. Now you have 63,000 of adjustable income, less the standard deduction, but you're still in a 12% tax bracket. And so the ordinary income is taxed at the same tax brackets, but that 6,000 is broken out and taxed at 0. And so your tax is exactly the same. So when I see someone's tax return that we've not done the money for, and I'm like, oh, we had an opportunity to reposition things. Like, pay attention to your income. If you didn't work for half of the year, if you are, starting Social Security, if you have to start your RMDs, like look ahead a few years to say, how is my income going to change? Because you have these brackets that aren't going to change dramatically, they'll change slightly, but you can look and say, what kind of income do I have? And where am I falling in those brackets? Because I got to generate $6,000 of income, maybe sell a stock that's doing really well or reposition because I want a different allocation in my investment portfolio. And now I have the same amount of tax. If you don't do that, you just lost. I always say it's kind of a lost tax year that we didn't get to take advantage of. Little side note, again, capital gain is taxed at 0 if you're in a 10 or 12% tax bracket. And if you go back to your charts, if by chance you sold, like $10,000 and you went over the 48,000 and you got pushed into the 22% tax bracket, you're only going to pay 15% on that difference because capital gains are taxed at a different rate. So it's not like an all or nothing like the Affordable Care Act health plan. This is graduated instead of a cliff. Okay, so paying attention to the brackets you're in and what kind of income is really important. Another one is a bunching idea. So I did this backing up to 2023 because these rules were in place and now they're going to change going forward. So let's pretend in 2023, 24, and 25, you made $10,000 of charitable deductions. You have $7,000 of mortgage interest, but you expect that to be declining because you're paying down your mortgage, and you're limited to $10,000 of state and local income taxes. And so you have 27, 26 of, total deductions. However, if you're married filing jointly in 2023, the standard deduction was $27,000. So none of this matters because the standard deduction is more than your itemized. But what if you think ahead and you say, well, I'm going to give to charity every year. That's like part of my giving plan. I know I'm going to do that. If instead you said back in 2023, I know I'm going to give $10,000 a year. If instead you gave $30,000 to charity, especially like this year, the market's up, you're doing well, you maybe want to contribute to a known entity or to a donor advised fund to get that charitable deduction. Same $7,000 of interest, $10,000 of state and local income taxes. Now you have $47,000 of deductions and you're over the standard deduction, and you end up saving anywhere, depending on the rest of your income and tax bracket, somewhere between $2,300 and $6,100 of taxes. And so the next year you would go back to, not itemizing, but then you would bunch again. And sometimes I've done this like every other year. It really depends on what expenses you have. But the bunching idea is a really great way to save on taxes. Okay. Always, you can make more retirement contributions, kind of the example Ralph gave earlier. Like if you know what your income is and you're going to hit a threshold, consider making a retirement contribution or an IRA contribution to bring your income down so you qualify for some of the, if you're close, to qualify for some of these credits and deductions if you're buying the car or doing whatever. A big one I'm not going to go into, but harvesting your investment losses against gains. Not a ton of losses in portfolios right now, but if you have them, take advantage, because if you sell something that has a loss, it will offset something with a gain, and it's a way to make it a tax neutral event. So RMD, it's on your sheet, is a required minimum distribution. A few years ago that changed. You don't have to take money out of your IRA until you're 73. It's the year in which you turn 73. So even if you just turn 73 on December 31st, it's anytime during that year you can take the distribution. Again, another way to bring your adjusted gross income down is doing a qualified charitable distribution. Again, if you're make it complicated, they kept the old RMD age of 70 and a half, which used to be the age you had to make IRA distributions. You can start making distributions from your IRA directly to charity. And when you have to take an RMD at 73, let's say you have to take out $20,000. Calculation says you have to take out $20,000. If you gave 1,000, 2,000, any number, let's say you gave 5. If you had to take out 20 and you gave 5 to charity, now you only have 15 that's taxable as an IRA distribution. And the reason this matters, we have a lot of clients who do this. Like if you give 5,000 to charity, now you're under the IRMA limits for your Medicare premium, and you're going to save between the two of you $2,400 for that $5,000 tax credit. It's like a double benefit. Charity wins. You really aren't paying all that much, plus less in taxes. So understanding where your income falls relative to phase outs and relative to your tax brackets, relative to Medicare income limits, these are all strategies that help you get your income where you ideally want it to be. Another, I say this to, okay, don't have that transaction close until January 2nd because we need it in a new tax year. Or often I'm having people look at when are you retiring, because maybe we need you to retire and have COBRA for 18 months, but maybe I need you to retire and I have leeway to have higher IRA distributions, but I don't want you retiring in December and getting this huge payout. I want you retiring in January and getting a payout. Like the timing of even when you retire and how your income is paid matters. So whether you're selling a property or taking a big distribution, another big thing with inherited accounts, the rules changed on those a few years ago. And if you inherit, most people, there's rules that with different rules, but most people inheriting IRA money have to take that out within 10 years. And so knowing, again, looking at what your income's going to be over the next 10 years, there might be an opportunity where before you start your Social Security, or maybe in year 6 you retire, and now we use that in the last 4 years of the 10 years that you have. That's where the timing of your income and the planning comes, where a lot of money can be saved if you map that out. Of course, Ralph talked about the HSA, the health savings account, which you can invest and continue. The FSA is something that has to get spent before the year end. So don't leave money in your account if you're contributing to an FSA. Some people have grace periods of another 30 days or so, but it's something you got to spend. The IRMA limits, again, those pertain to Medicare. So if you're over, it's about 112,000 for single and 212 or 215 for married. If you're over that for your adjusted gross income, now you pay more in your Medicare premiums in your Part D. So IRMA limits, again, planning for that. The other thing is consider Roth conversions. A little tip, do Roth conversions if you can move money from your IRA into a Roth. It is taxable. And remember, if you were to do that before you were 9.5, do not have tax withheld from that conversion, because it is a pre-59 early penalty, 10% early penalty. It's considered a withdrawal. So if you are not 59.5, you want to do the Roth conversion, but have no tax withheld from the conversion and pay that tax out of other sources. Otherwise, you have a 10% early withdrawal penalty and taxable income. Of course, reflecting on your financial goals for the year ahead. I want to cover just one more topic, and then I hope we can get to questions. You can tell we're kind of passionate about this. Our entire team is passionate about this. And on our ITS team, we have several preparers, accountants, we added it up over nearly 200 years of financial planning and portfolio management between ITS and our financial planning team. So we Integrated Tax Services, tax and accounting firm, and is affiliated with Johnson Bixby, who is a financial planning and wealth management firm. And then we have an entire phenomenal team of administrative support to help everything run and give the most awesome client service we can, because we love our clients. You can see how passionate, hopefully you can see how passionate I am, but all of our team members are very passionate about what we do, and we care deeply about our clients. And we spend time getting to know you, because it's not a transaction for us. It is, how can I help you be as successful as possible? And I'm all about paying your fair share of taxes, believe me, but let's be as efficient as possible, because there's rules to play by to be paying what you need to, but not more than you need to. And I'm all for that. So with that, Ralph, I'll have you come on back up and we'll open it up for some questions.
On your tax return, your rental income is separate from the standardized itemization.
So I think what you're saying, so the question was, rental income is separate from your itemizing. So it is, I think what you're saying is, yes, if you have rental income, any deductions associated with that rental property are on your Schedule E and not part of your Schedule A itemized. So yes, those are two different forms of deductions. And it's just a matter of what the expense is, whether it goes on one or the other, and not to complicate things, but like if you have self-employment Schedule C income, it depends on what you have for income as to whether or not you end up deducting certain things, like your health insurance goes on the front page. It doesn't go on your Schedule C. So there are some pieces with self-employment, it shows up on one piece, or if you're over on interest deductions on a rental, some of it might flow through to your Schedule A for itemized deduction as well.
Okay.
So I hate to say it depends, but it always does.
You sound like an attorney. Well, it depends.
Other questions? Yes.
Are there any changes with the long-term care deductions coming off the ADLs, the activity for daily living?
I don't think there are any deductions changed by this bill
Regarding long-term care.
regarding long-term care.
Yeah.
That,
So they can still be-
no changes there, still deductible the same amount per age.
And I do believe those are indexed for inflation.
Yes.
Yeah, so they'll go up slightly how much, but yes, those are an additional health care. They're a Schedule A health care limit. So subject to the 7.5% of your AGI as a medical deduction. Oh, what I was just talking to someone, so I'm going to mention this, who has, they do their own return, which is fine, but they were not putting their Schedule A, and by that it's the interest, property taxes, charitable, into TurboTax, because they said, oh, I'm taking the standard deduction. And I'm like, no, if you're in a taxable state like Oregon, California, anyone here other than Washington, you want to put those in your tax return because they help you on your state taxes. So even though you might take a federal standard deduction, you still want to put that in there, including your medical. And you'll have to, like nitpick it. There's only a limit to the deduction, but you want to include it.
That's absolutely right. I mean, you've got all sorts of issues with the states because they're different than the feds, right?
Is there anything specific in these changes one should know if they're a 1099 versus a W-2?
So a 1099 versus a W-2, the IRS has very strict, I mean, they've got like a 10-question checklist to determine whether you're supposed to be an employee on a W-2 or a 1099 where you're self-employed. And they're pretty strict. If your employer, the person that is paying you, oh goodness, if they control what you do, where you do it with their material, you're probably supposed to be an employee. And the IRS loves employees. They're not wild about self-employed people on a tax return. It's still legitimate. You just have to make sure that the person paying you is doing it right.
I think if you're like in real estate or one of those categories that's a typical 1099, there are some things like maybe vehicle purchases that would really only apply, and it only applies in some of the categories, because if you're not using that vehicle for a majority of your work, then it's not. So there's some obscure things, but in general, all of this doesn't matter. It's AGI.
Right.
However you get there.
Heidi, they asked online if you could repeat the thing that you went over really quickly about donating to charity or elementary school donation, that scholarship fund.
Yeah, we don't have enough information on that.
Yeah.
For the donation for the scholarship, we tried to do a little bit more research, and they really don't have enough out on that.
The IRS just hasn't written the interpretation of those quite yet. So some of these things, it's the best efforts at this point.
And some of it too that we wanted to mention, it might not apply to you like an adoption credit or other things, but you have friends, you have family. So hopefully these topics that we touched on, if it comes up in conversation, you're like, oh, there's something new in the tax law about that. At least you know to go look for it. Yes.
Going back to when you talked about taking RMDs from an IRA and you could take part of it and put it into a charitable donation. Could you talk more about how that works? I mean, can you take your RMD and then, okay, it has to go directly.
It does. So to do what's called a QCD or qualified charitable distribution from an IRA, you just have to be 70 and a half or older. Your RMD isn't required until 73. But the money does have to go directly from your IRA to charity. And what most custodians offer is a checkbook. And so you get a checkbook issued on your IRA and you write a check like a normal check, but it clears on the cash in your IRA. And so that's how you then send a check, a normal check, but it's clearing on the cash in your IRA for you to get that deduction. And a couple things with that. One thing about a QCD is it has to go directly from your IRA to a charity. You cannot give your QCD or IRA distribution to a donor advised fund. That's a rule. We have clients who have both. And the reason the reason we do both is the QCD is nice if you have known charities that you give to, because it has to go directly to a charity, like, standard giving that you're usually doing. And it's usually a more sizable amount. Let's say it's $500 or more, because you do have to track and show that that money actually went to charity. If you accidentally write a check, to your kid as a gift, or pay your Albertsons grocery bill, that doesn't count. And so it's still a taxable distribution under that instance. So those checks are meant only for charity. A donor advised fund works differently in that usually you can put cash in it, but usually what we're doing is taking appreciated stock. You bought something for $10, it's worth $1,000. You move the shares of whatever you bought into a donor advised fund, and you get $1,000 worth of a charitable contribution as an itemized deduction. Going back to my bunching strategy, you get credit for the $1,000, but what you're doing is avoiding the capital gain by not having to sell that holding. So you get $1,000 of credit. Now it's in what's called a donor advised fund that you can turn around and give away, or accumulate money in the donor advised fund and give it over time. It's a big way that we do the bunching strategy, because you don't want to give away 30 maybe right away. And so you do the donor advised fund. Or it's like, no, I'm contributing to a capital campaign, I'm IRA eligible. You do a QCD and you're done with it.
So let me add one thing to that, if you could. On the tax side, when you do those checks or you do that money that goes to a QCD, it does not change that 1099.
Ooh,
And so are they going to do a Q code this year? In theory, you got to let us know that has happened.
Yeah.
Because we don't necessarily know unless it's.
Well, so a new thing this year is they're supposed to put, where you have the 7 code as it's a normal distribution, they're putting a Q, the 7 and then a Q, to just indicate there was potentially some QCDs that came out, to give you a heads up.
And the problem is, it doesn't mean all of it.
Yeah.
So we still have to know what those numbers are, even if they do get the Q code on there.
Yeah, that's the one thing.
Keep track.
Maybe too much information, but no custodian wants to be responsible as to whether or not you gave to a qualified charity. So no custodian is going to detail that. You have to know, hey, I had to take out 20, I gave 5 to charity. You have to report it correctly on your tax return. Your 1099 will not delete that. Yes.
Kind of continued on with the R&D. Are there any other planning options or advice that associated with tax laws or whatever with the R&D?
I think one of the biggest things that we try and look at is, well, before you are RMD required, is we try and look at how can we maximize those tax brackets, and we look at what is your RMD going to be. Let's say your RMD is going to be $50,000 a year. It's like you have, unless you're willing to give some to charity, no way to control that being taxable income. So one of the things we try and do is if you're gonna have lower income years up until that point, we try and get that money out, either a Roth conversion or get it out and put it in a taxable account so that it's more getting the IRA, keeping the IRA at a certain balance rather than, oh, all these cheap tax years and then all of a sudden you have to pay this huge amount. And the other reason to do that is also to try and keep you under the IRMA limits for Medicare purposes. So I would say look well ahead of your RMD age if you can, because really the only other thing is to, let's say your RMD, your RMD is, again, $20,000. You can give all of that to charity if you want to, and you're allowed to give up to, it's 108 or 110, 108 this year, I think. So even if your RMD is 20, you can give 108,000 a year out of your IRA, and it's still, then it's tax-free. Yes.
I'll make a plug for Ripple Impact Northwest. If people are wanting to do the charitable giving and they don't know which nonprofit to give it to, I'd love to talk with you after this.
Talk to Megan.
Yes, talk to me.
When you're starting a company and you want to do your research and development costs, is your own work or what you pay yourself also in those costs for development?
That's a great question. Research and development, if you're a business that's under 31 million in gross revenue, is a very, very strict set of guidelines that you have to qualify for that. We don't have time to go through that now, but that is definitely something to research.
It's kind of more like a engineering firm. It's not usually a small self-employed person.
Not usually, true.
Not usually.
Okay, I'll ask you later.
But yeah, it's definitely something that's a possibility to use. You just have to research all of the rules.
And it really has to be physical sciences or computer sciences.
Yeah. Physical sciences, computer sciences, those are big R&D pieces.
Yeah, like social sciences generally
Don't qualify.
Can you give to the 529 out of an RMD?
That is not considered a gift. So you can, the question was, can you give an RMD to a 529? You can take a taxable RMD distribution, it's taxable income, and give it to make a 529 contribution, but there's no tax-free way to take it as an RMD and then put it in a 529. Just take it as a taxable distribution. All right, we are over time. We will be here if you have individual questions. We really thank you for your attention on this so exciting topic.